Good morning. I'm Shekina Tuahene, Deputy Editor and Commercial Editor of Mortgage Solutions. Welcome to the first session of this year's Mortgage Administrator online event, where we'll be looking at the UK economy and how it might shape future trends in the mortgage market. To start, today is CPT accredited, so the objectives of this event are understanding market dynamics and challenges, optimizing mortgage submission processes and understanding lender requirements, enhancing client engagement through protection strategies, and developing strategies for personal brand establishment. For this first session, it will be moderated by Rob Barnard, Relationship Director at Pepper Money, which is also our headline sponsor. We'll be joined by Beth Clayton, Senior Relationship Manager at Vive Finance, and Rob Owens, Head of Research at e.surv Chartered Surveyors. Thank you all for being here today. As a reminder, there will be an opportunity to ask questions throughout the session and at the end. So submit them using the box on your screen, and I'll come back to field your questions to the panel. For now, I'll hand over to Rob.
Thanks, Shekina. Good morning and a very warm welcome to the first session of the day at today's Mortgage Administrator online event. As Shekina said, I'm Rob Barnard, Intermediary Relationship Director at Pepper Money, and I'm your host for this first session of what will hopefully be an action-packed day full of great content, views, opinions, and of course debate. In our session this morning, we'll be looking to analyse the current macroeconomic climate and its impact on mortgage lending, uncover emerging trends, and forecast the future of the UK's property and indeed mortgage markets. We'll also be looking to discover the challenges and opportunities facing lenders, distributors, and the broader marketplace in this insightful session. Whilst looking at this, hopefully you'll gain valuable insights into significant opportunities and reasons for optimism in the evolving mortgage landscape. Hopefully, at the end of the session, if we've done our jobs correctly, of course, you'll have a better understanding of economic drivers in the UK mortgage market, be able to identify current affordability challenges faced by borrowers and lenders amidst changing economic conditions and regulatory environments, and also be able to assess the operational challenges encountered by broker administrators in managing mortgage applications and client relationships. Now, I couldn't do this on my own, of course, or if I did, I promise you it wouldn't be very enjoyable. And so I'm delighted to be joined this morning by Beth Clayton and Rob Owens. Beth is Senior Relationship Manager at Vive Finance. She's over 14 years experience in the mortgage industry across both high street and specialist lending. And during this time, she's gained a thorough understanding of the whole mortgage process, working alongside underwriters and on-site lenders, and also, of course, liaising daily with solicitors, brokers and clients, supporting them with all aspects of the lending process. Beth's role at Vive is as Senior Relationship Manager, and that sees her manage complex processes and obviously also manages a live pipeline of applications. She also oversees Vive's operations team to ensure a smooth application process for all her clients. She's passionate about building strong client and lender relationships and using her industry expertise to help clients get their mortgage applications over the line as quickly as possible. And Rob is Head of Research at e.surv, a leading UK property valuation and surveying service provider. He's got over 15 years experience in the property industry and has held senior research and analyst roles at Zoopla and HomeTrack, a leading provider of residential property AVMs and market insights. Rob began his career in social housing with a G15 provider, where he held senior positions in corporate and development finance. And at e.surv, he uses property market data sets to generate high quality research and insights tailored to lender clients, enhancing their decision making and strategic planning capabilities. There we go, Rob, we've built you up there. Beth, Rob, thanks so much for taking time out of your busy days to join me this morning. Well, I tell you what, guys, what the mortgage world's a dull old place, isn't it? Nothing ever changes. We never face any challenges. And to be honest, I haven't really got a clue what we're going to talk about for the next 15 minutes, the next half an hour or so, do you? But I'm sure we'll find something. So let's kick off by having a look at the shape and size of the UK mortgage market. COVID certainly brought a challenging landscape for many, but then as it started to sort of reduce in severity, the mortgage market bounced really well. Borrowers sprang back into life and activity levels were really strong until September 2022, and that fateful day when the fiscal statement was made to Parliament by then Chancellor Kwasi Kwarteng. The market went into turmoil, products were pulled at an alarming rate, and stress levels all around the industry went through the roof. Now, at the back end of last year and the very early part of this year, we did start to see the first signs of significant rate reductions, but swap rates have certainly remained very volatile ever since. So, Rob, if I can come to you for this one, what's the mortgage market looking like at the minute? I mean, the economic environment certainly seems a lot better maybe than it was 12 months or so ago. And the mortgage sector has been obviously resilient throughout. But what are volumes and buyer activity currently like? And where do things need to be for the mortgage sector to feel good? Or is it in a good place already?
I think the mortgage market has shown, some remarkable resilience. And as you say, kind of since the tail end of last year, we've seen kind of, volumes start to increase, heightened buyer activity as well. So I think, that uptick is largely due to kind of improved economic activity, obviously rates settling down, obviously not where we'd like them to be. But, that kind of stability does help people kind of progress their transactions, really. I think where we currently are, if you think back to kind of 2023, we kind of finished the year on around 1 million, just under 1 million transactions for the year. In the long run average is around 1.2 million a year. Up until, we were kind of the current run rate is around 1.1 up until obviously Rishi's announcement, which I'm sure we'll be talking about later. So yeah, definitely an upward trend. I think what we're seeing is definitely people come back to the market, and as you say, with the recent news around kind of interest rates, inflation going the right direction, and obviously swap rates will hopefully follow. They've been quite stubborn for the last 5 or 6 months, so hopefully as they start to fall, mortgage rates will fall, and that will hopefully have a positive impact on buyer activity.
Yeah, that's good. I mean, it's interesting, isn't it? I mean, the greying little bits around my temples suggest I've done this for a little while. And when I started out, the Bank of England's base rate sort of decision every month, that basically set your lending parameters for the following month. I mean, swap rates these days drive activity, don't they? So people keep talking about, and we'll touch on this again in a little while, people keep talking about when's the next base rate check coming. But things that happen maybe in the Middle East, in Ukraine, all these sort of things can have an effect immediately with regard to swap rates. And we see that, don't we?
Oh, exactly. And I think, what we've seen in the news in the last couple of days around lenders actually starting to drop rates, kind of ahead of a proposed Bank of England decision, I think kind of tells you all you need to know. We know it's going to happen. I think lenders are getting more comfortable with where they are. As you say, kind of those Ukraine, kind of Middle East, it's still there, but it seems to be relatively stable. So hopefully, as I say, mortgage rates will start to decrease.
I mean, people talk about affordability being a big challenge to the marketplace, but I think stability is a big challenge as well. We've not had any of that sustained pipeline building, have we, from the mainstream lenders? I think it's only just around the corner. And I would say this from a specialist lender's sort of background, and Beth, I know you're sort of specialist at heart as well. I just think when the main banks and lenders do start to pipeline build, they might just be that little bit more selective about the type of business they take. So it might give specialist lenders like Pepper and my peer group an opportunity. I mean, Beth, your role must have changed significantly over the last over time, but certainly since that fateful statement to Parliament in 2022. I mean, I've never seen rate pulls as ferocious and quick as they were taking place at that time. And I know for a fact, for example, if we were holding this event probably in October or November of 2022, there would literally be 2 people on it, because you couldn't go away from your desk for fear of missing a product pull being taking place. I mean, it must have been a nightmare for you as an administrator to sort of handle and deal with. How did you actually deal with the speed that these were thrown at you? And did you have to change and adapt your administration style and approach to keep them on top of your pipeline of cases?
Yeah, so I think everyone can obviously remember back then, it's kind of ingrained, and no one really could prepare for the speed that the rates were pulled. So at the time, it was just a case of kind of taking a step back and prioritising what applications we had. We had, as you can imagine, brokers had emails coming in left, right and centre, sometimes up to 15, 20 a day, just with lender rate pulls. So it was a case of taking a step back and kind of dealing what we had there and then, almost hour by hour. We had different deadlines that we had to meet. So it was just a case of, okay, right, which one was more priority than the other? Which one do we have to get in? And contacting clients and speaking really closely with lenders, business development managers, just to make sure everyone was kind of kept in the loop. But the main thing was mainly clients. We still had a huge number of applications coming in, but it was contacting those clients and letting them know, that we've got less than 24 hours to get your application in. We need to secure your rate. So at the time, it was definitely a challenge. It has definitely calmed down now, although it is still happening. So the rate pools and the rate changes and things are still coming in. So we're still adapting that process of what we had, maybe not hourly by hourly, thank goodness, at the moment, but certainly still adapting the process of prioritising what is important for us.
And I spoke to sort of quite a few brokers at that time, and you build relationships with your customers over many years, don't you? It's the same as my job. You build relationships with distributors and brokers over many years. You build your relationship with your customers over many years. And all of a sudden, this nice, friendly, relationship-based broker had to change his style, because all of a sudden, the guy you did a dip for at 9 o'clock this morning, he was ringing at 10 o'clock saying, if you want that property, I need all your documents in now.
Exactly that, Rob. Exactly.
And it changed. And I don't think that would have been, it wouldn't have sat well with me, because I'd have been all of a sudden become a hard salesman, or it appeared to become a hard salesman.
It was a case of kind of training around clients. The brokers, obviously, at the early stages, they know kind of what inquiries are coming in. When it comes over to the administrators, that's kind of when it's ready live to submit to the lender. So it's working really closely with the brokers to ensure that we're contacting clients as soon as there's kind of an inquiry there to explain. And as soon as we saw the rate pools in, calling them and saying, look, it's a bit unstable at the moment. We need to get your application as soon as possible. Please don't panic, but there is an urgency there.
Yeah, and I think if it's done any good to the marketplace, I'm hoping that more and more lenders are giving you more time now.
Yes,
because they recognise the stress and strains on mental health it was putting on people.
Yeah,
absolutely. In a later session today, but it definitely messed with a lot of people's heads doing that. So again, the more and more lenders that can give a longer timeline to convert, I think is better for everybody. And I get it, don't get me wrong, some of the mainstream lenders who are lending billions a day, if they leave a product out only a few minutes, never mind hours longer, they can get swamped. So I think there's something happening next Thursday, 4th of July. I think, it's a general election. I mean, that's sort of come around very quickly from that rain-drenched afternoon in Devon Street. I mean, so this time next week, we are going to the polls for the country to elect a political party to office. Rob, what do you think will be the impact of next week's general election? What should we be looking for maybe in each of the political parties' manifestos that might appeal to the housing sector?
Well, I think first of all, usually when we have an election, there's an impact on transactions. Interestingly, this time round, I've done some number crunching. Based on new mortgage instructions coming through, we're actually about 16% up from when Rishi made that announcement. So it seems that instructions people are still carrying on with those. If they're, I guess if you're still if you're in a transaction, you're in a chain, you're probably pushing through. I think probably where we usually see perhaps people stepping back a bit is those yet to make that kind of decision. So, defer it a couple of months, come back, see who's in, and see what they're offering, and maybe it's stamp duty holidays, maybe it's something else again. So I think I guess this election though is a bit more interesting in terms of policy, in that between the two major parties, there isn't much between them in terms of policies. I think the wider recognition really is around delivery of homes. So, I think all of the parties have obviously come back and said, it needs to be somewhere in excess of 150,000, and that's different mix. It could be social housing, it could be private housing. I think delivery is the big one here. I think in terms of kind of the smaller giveaways or policies there are, I think Labour obviously has the mortgage guarantee scheme, the extension of the mortgage guarantee scheme, which is the 5% deposit. I think Conservative, obviously, having a bit of an uphill struggle, or potentially having a bit of an uphill struggle. Reintroduction of Help to Buy, capital gains tax holiday for buy-to-let investors as well. So if you sell the property onto the incumbent tenant, as I say, I think those smaller policies probably not the biggest concern. I think that it's all really around delivery this election and who can actually deliver, pun intended, I guess, on getting those homes built.
Yeah, and I think you're right. I think Help to Buy in the scheme that was introduced a number of years ago now was very successful. It'll be interesting to see if anything like that would be reintroduced, because I think there's been several sort of privately funded schemes, haven't there, that have tried to sort of plug the gap left by Help to Buy, but I don't think any of them have really got that massive impetus.
I think exactly right. I think obviously Help to Buy obviously was government backed. Had the scale. Had the scale to deliver. 50-60% of homes during kind of the peak of Help to Buy were being delivered through Help to Buy. So, it was a big policy. It was a big scheme. I think it feels like a challenge to bring it back. I think it was almost a bit of a giveaway. I think the smaller private schemes just didn't have the scale or reach. And that's kind of what did them in a little bit, I guess. But I think there has, as you say, affordability is another kind of key foundation here, and trying to figure out a way to get around it. Obviously, something like the mortgage guarantee scheme, if mortgage rates kind of trend in the right direction, could become more attractive.
Yeah, I mean, you look at it, and we as lenders, we do get sort of hit with sticks a little bit about our 4.5 times income sort of cap and how much we can lend over and above that, and that's obviously a regulatory position that's imposed upon us. And there could be more selective, maybe use of it slightly above 4.5 times, but you also look at the cost of living crisis we've been through over the last 12, 18, 2 years. Probably the 4.5 times cap probably helped arrears not spiral to anything like was feared, I think.
Well, no, exactly. We didn't see a big price crash. We've gone through COVID, we went through the Liz Truss tenure, and we survived both. House prices have been relatively flat, but I think the regs have done what they're supposed to do.
And affordability is key. I think if we're stuck with our 4.5 times cap, then I think it's making more of affordability, and specialist lenders obviously can help by that, using different types of incomes as well. I mean, the only thing on the political play before we move on, one thing I'd like to see personally is somebody put into a position of housing minister, given a slightly wider brief, but given time to sort of get into that role. Give him a seat at the cabinet table. I think I've just had a look. We've had 16 housing ministers since 2010, and that's more managers than Watford have had. It's absolutely ridiculous. We need some stability, I think, in that period, and some sort of gravitas about a fundamental part of the UK's economy.
Well, I think you're exactly right, and the fact that all the parties seem to be in violent agreement about the need to be building homes. In an ideal world, obviously, it would be kind of an apolitical body actually doing this work instead of kind of being tied to a party.
Yeah, I mean, and Beth, I think one thing that's been talked about probably loads in the press is the potential for this Bank of England base reduction. And I think people are maybe just sitting on the hands. Nothing's going to happen greatly over the next couple of weeks until the new administration is in place. So we're expecting to maybe see something positive in the second half of the year. But if rates do fall and the market continues to improve and improves further, how can administrators like yourself support brokers in managing a possible and sudden influx of business, which would be a great end to the year?
Oh, it would be amazing. It would be really good, and I think the industry is ready for it. Administrators, I think the rate pools back in 2022 and have been since has put administrators in kind of a good space to be ready for an influx. If we could have dealt with the rate pools the way we have, which we did successfully, I think it goes to show that we're ready for kind of anything that hits us. If we can get through that, we can do the easy bit. I think communication with your brokers, with the lenders, with everyone involved is going to be key. We have a kind of a robust system where even when the rate pools reducers are coming down, during the application process, we've got a process in place where we kind of contact the clients, contact the lenders, see if they can do that. So influx, it's just key to speak to the brokers to see kind of what is happening at the front end to see what's coming over, and just prioritising in what we've got. So, new applications coming in, to be able to submit them may take priority over ones that are already at legal stage and in the hands of solicitors. So it'd just be a case of prioritising what comes in, just to make sure that we're securing as much as we can, as quick as we can when it comes.
Yeah. Brilliant. And I think I've spoken to so many brokers over the last 12 months where transaction levels maybe have been a little checked. We've not in mortgage terms. Yeah. Oh, I'm so busy. Now, a lot of that has been put at the door of PTs, I think. So yes. Wouldn't it be great to see rate reductions, increasing sort of new transactions moving forward at pace as well? I mean, do you see that lenders' SLAs sort of vary significantly as well? And does that play a part in where that case is actually? And I know you've got to give best advice, got to be the best product, but does it come into the sort of decision-making process that your advisors would consider? Absolutely.
When we're contacting clients at the front end, we're asking the questions, what's important to you? Is it the rate or is it the speed? We keep up to date with all the lenders' SLAs. We contact them regularly to see where they're at. If there is a particular lender, it's not many, there's a few, and it does differ from lender to lender. But if there are increased SLAs, it's a case of informing the client of that at the early stages of the process. And it's just about managing expectations. If speed isn't important to them and they know there is a current long SLA, but they particularly want to go with that lender for that rate, then absolutely we'll still look at that option for them. If it's speed, then we'll give them other options.
And it's a blended advice, isn't it? So exactly. And we'll come on to service again very shortly because it's something that's at the centre of everything I believe in. I mean, Robbie, it would be wrong. You work at e.surv. I mean, you certainly got your ear to the ground with regards to the property market, which is really good. What's the word on the street? What are the guys in the suits that have got the damp meters in the wall? What's the word on the street from the surveyor world?
I mean, surveyors are generally optimistic about the current property market. There's a sense of stability in market valuations. I mean, supported by strong or growing buyer demand, steady mortgage rates. I think the two pinch points right now are probably around construction, so new build, and the use of incentives. Obviously, that kind of ramped up quite heavily. Obviously, with the loss of Help to Buy as well, that kind of incentive part of the deal was quite noticeable. And again, coming back to affordability, it tended to be kind of incentives up front. So things like, help with deposit, stamp duty support, or support with legals. I think the other side of the coin is probably the buy-to-let market. I think anecdotally you're hearing a lot about. Hey, it's almost like I read your mind. Yes.
Is it dead?
Ish. No, not really. I think there's still a lot to buy-to-let is still pretty strong. I think where we're seeing the most pain are those smaller investors, obviously dependent on mortgage finance. The higher rates have definitely kind of made it more challenging. Obviously, with the rental reform bill, obviously it didn't go through prior to the government kind of calling the election, but both parties have committed to kind of rental reform coming back after July. Two slightly different flavors, but the key points are still the same. I think that's the challenge really for me on buy-to-let. It's really around those smaller investors. I think larger investors who are obviously less dependent on mortgage finance are doing pretty well. Rent increases in terms of price rises. Up until very recently, we're kind of in the double digits annually. So, pretty punchy rent increases. Demand's still there. We've got a real supply problem. We don't want to be getting rid of these kind of smaller amateur landlords, but unfortunately, they are at kind of the pointy end of the stick, and it's hopefully mortgage rates as they start to come down, things might start to ease a little bit.
Let's hope so. I mean, and I think I concur there. I think we used to refer to them as the dinner party landlords, maybe those that sort of have things to supplement a pension down the line. Maybe we're not seeing quite as many of those. But what we are seeing is diversification of portfolios as well. People getting a little bit more switched on into HMOs, into multi-unit blocks, holiday lets, Airbnb, all that sort of stuff. So let's hope it continues. I mean, time has nearly beaten us, guys. We've got time for just one final question each. So, Beth, if I can come to you first, what words of advice would you give to our listeners out there to ensure that they're making the most of the challenging market we're currently facing?
I think just communication's key. I think, we're all in this together. Communication we work so closely with lenders, administrators work so closely with lenders, brokers, solicitors. I think just as things adapt, and I think it's clear to see since 2022, that communication really is key, and prioritising when you're faced with challenges. We don't know what's around the corner. We didn't back in 2022. So it's just a case of adapting and being there to support each other. We're all in it together.
Totally. And I just had a couple of things onto that, Beth. I think, and we've talked about this before when we've caught up, where you have access, where have administrators and brokers indeed have access directly to underwriters, use it and abuse it, because it will be the best 2 minutes of that whole process if you've got a direct line to a decision maker that holds the pen, because at the end of that 2 minute conversation, the case is either dead and you need to replace it somewhere else, or you know exactly what's needed to get the case over the line and get the offer issued. So let's if you've got that, use it. And I tell you what, use your BDM resources as well. I know you don't need to see people all day, every day, but if you've got a really good BDM, a regional development manager, they're worth the weight in gold.
Yep, we do. Yeah, and Rob, it's worth its weight in gold. Both of those things.
Brilliant. And Rob, last words to you. How can people make the most of the opportunities in this challenging environment?
I think things are improving. So I think making the most of it, it's really around, kind of sticking with what you're doing at the moment. I think, the market is definitely turning. I think buyers are coming back to the market. I think, we've had a period where it's perhaps, it hasn't been discretionary moving. It's been forced moving. I think where it's coming back. I think it's just hopefully get ready as rates kind of drop to that 3.5–4%, area. I think that will bring people back, and that's probably the new normal in terms of rates. And then hopefully, see where we are in 12 months' time. See you in 12 months, and we'll see how we did. We'll
play the recording and we'll pick the bones of it. So a final thank you to Beth and Rob for joining me today. It's been really great to get your thoughts on the shape, size, and challenges of today's market. It may still be a challenging, but with every challenge comes opportunities, and we just have to make sure, I think, that we're there to make the most of each and every opportunity that sort of presents itself. I hope you found the session useful. We've got some questions. I can see they're starting to drop in the box, which is great. Hope you found it enjoyable as well, and hope you enjoy the rest of the day's sessions. I'm back later with the last session of the day, and so I hope to see many of you there if we've not bored you over the first half an hour. But until then, thanks very much for joining us, and I'll hand back to Shekina to wrap up with any final questions that may have come in.
Thank you very much. And we do have some questions come in, and I think you have to get your crystal balls out for this one. So the question is, as a mortgage administrator, soon to be a first-time buyer, can we anticipate any significant increases to resi purchase prices at the end of the year or the beginning of next year? So who wants to take that one first?
It's got Rob's name written all over it, Shekina, about property prices.
So I think in terms of property prices, we don't really expect to see kind of any major rises. The market's probably been kind of, low single digits per annum. So kind of, 2–3% rises. I don't really anticipate kind of a big uptick in pricing by the end of the year, no.
Yeah.
And I put it like this, Rob, in some ways. I mean, I think people look back at the challenges that we've faced since 2022 and said, oh, it's another financial crash. And it was nothing like it. It was totally different. That was a liquidity challenge. We've never faced a liquidity challenge. And I think the saving grace is that the property market hasn't crashed. I think it's just been I describe it, I don't know if you agree, Rob, it's a bit like, it's just knocked the froth off. It was getting a little bit toppy, and it's just been a bit of a correction. It's just knocked the froth off a little bit.
Exactly. I think that's a very good, yeah.
Thank you.
Any more questions? Don't be shy.
I think that is all we have time for. So if any more questions do come through, then we'll get the team to answer them after the event. But thank you to Rob, Beth, and Rob for kicking things off with us today. I'm sure everyone found that interesting, insightful, and are prepared to what's come to the year ahead.